The silence on the market. There was a time when homes in the Northeast barely touched the market. They appeared on a Thursday. By Sunday, they were gone. Offers stacked. Buyers waived inspections. Escalation clauses became routine. That was not ancient history. That was 2020 and 2021. But today, the same streets in places like Boston, New York City, and Philadelphia tell a quieter story. For sale signs remain planted in frozen ground. Open houses feel slower. Price reductions appear more frequently. And the question hangs in the air. Why are Northeast homes sitting unsold? To understand this shift, we have to step back. Because this story didn't begin with rising inventory. It began with dominance. The Northeast was once the standard. For more than a century, the Northeast was America's economic command center. Finance concentrated in Manhattan. Insurance thrived in Hartford. Biotech expanded around Cambridge. Universities fed a constant pipeline of high-income professionals. Real estate in this region wasn't just shelter. It was scarcity. Geography constrained supply. Zoning laws limited expansion. Historical preservation restricted redevelopment. Unlike sprawling Sun Belt cities, land in the Northeast doesn't stretch endlessly outward. It compresses, and compression creates pressure. For decades, that pressure supported prices. Even during downturns, core Northeast markets proved resilient. After the 2008 financial crisis, values in prime areas rebounded faster than many other regions. Why? Because the Northeast wasn't just housing. It was institutional power. It was proximity to opportunity. It was legacy wealth. And when COVID hit in 2020, something unexpected happened. The market didn't collapse. It accelerated. The pandemic surged. In early 2020, fear gripped the economy. Then interest rates fell to historic lows. Mortgage rates dropped below 3%. Suddenly, borrowing felt almost free. Stimulus checks increased liquidity. Stock portfolios recovered rapidly. Remote work removed commuting constraints. And buyers flooded the market. Suburban Connecticut surged. New Jersey towns saw bidding wars. Even outer borough neighborhoods heated up. People wanted space. Offices at home. Backyards for children. Distance from density. At the same time, supply tightened. Sellers hesitated to list. Construction slowed due to labor shortages. Material costs spiked. Inventory collapsed. The imbalance was extreme. And prices climbed. In some Northeast suburbs, values rose more than 30% in 2 years. It felt unstoppable. But markets rarely move in straight lines. They overshoot. Then they correct. The turning point came quietly. Not with a crash, but with a decision. The interest rate shock. In 2022, inflation surged across the United States. Energy costs rose. Food prices climbed. Wages struggled to keep pace. The Federal Reserve responded. Aggressively. Under Chair Jerome Powell, the Fed began raising rates at the fastest pace in decades. Mortgage rates doubled within months. From under 3% to above 6%. Then higher. That single shift altered everything. A buyer who could afford a $900,000 home in 2021 could suddenly afford far less. Monthly payments ballooned. Affordability collapsed. Demand cooled. But here, where the Northeast story becomes different. In many southern markets, builders had overbuilt during the boom. In the Northeast, construction had remained more conservative. So why are homes still sitting? Because this isn't just about rates. It's about psychology. The lock-in effect. Millions of homeowners in the Northeast refinanced during the pandemic. They secured 2.7%. 3%. Historically cheap debt. Now imagine asking them to sell. To give up that mortgage. To buy again at 7%. It doesn't make financial sense. So they don't move. This creates what economists call the lock-in effect. Existing homeowners stay put. Fewer new listings appear. But at the same time, buyers hesitate. The result? A strange imbalance. Not enough supply to crash prices. Not enough demand to clear listings quickly. Homes linger. Weeks become months. And sellers who anchored to peak 2021 prices resist cutting. Because psychologically, the peak becomes the reference point. Even if the market has shifted. Migration patterns shift. There's another layer. During the pandemic, outbound migration from the Northeast accelerated. States like Florida and Texas attracted remote workers seeking lower taxes and larger homes. The Northeast has historically seen population shifts during economic transitions. In the 1970s, manufacturing decline pushed families outward. In the 1990s, financial growth pulled them back. In 2020, remote flexibility changed the equation again. If your job allows you to live anywhere, why pay Northeast property taxes? Why tolerate older housing stock? Why endure harsh winters? Some left, not permanently in all cases, but enough to cool demand. And when marginal demand declines in a high-priced market, homes take longer to sell. The affordability wall. The Northeast already carried some of the highest median home prices in the country. Add rising interest rates. Add property taxes. Add insurance costs. Add aging infrastructure maintenance. Suddenly, total ownership cost becomes heavy. First-time buyers feel the pressure most. Student loan payments resumed. Savings depleted from inflation. Rent remains high, but ownership feels riskier. So buyers pause. They wait for clarity. And waiting slows markets. But this isn't a crash. It's important to be precise. Unsold doesn't mean collapsing. It means friction. Days on market increase. Price cuts appear. Negotiations return. In 2021, sellers dictated terms. In 2024 and beyond, buyers regain leverage. Inspection contingencies reappear. Appraisal protections return. Credits are negotiated. The power dynamic shifts. Not violently, strategically. And this is where the deeper transformation begins. Because what's happening in the Northeast isn't just cyclical. It's structural. We'll examine the demographic forces reshaping demand, how institutional investors are behaving differently, why urban cores and suburbs are diverging, and the strategic mistakes sellers are still making. The story isn't about panic. It's about repositioning. And in real estate, position is power. The buyers who disappeared. Markets do not slow all at once. They thin out. Quietly. One buyer delays a showing. Another decides to renew a lease. A third recalculates monthly payments and steps back. Individually, the decisions seem minor. Collectively, They reshape the market. So who exactly stepped away from the Northeast housing market? And why? The first-time buyer squeeze. For decades, first-time buyers were the foundation of Northeast demand. Young professionals moved into cities like Boston or New York City. They rented. They built careers. Then they bought condos, starter homes, co-ops. That cycle sustained the market. But the math has changed. A $750,000 condo at 3% interest felt manageable for dual-income professionals. At 7%, the monthly payment can jump by thousands. Add HOA fees. Add property taxes. Add closing costs. The margin disappears. Meanwhile, student loan repayments resumed nationwide. Savings accumulated during stimulus periods thinned under inflation. And lenders tightened underwriting standards. The result? Many first-time buyers remain renters longer. Not because they don't want to buy, but because the risk feels higher. And uncertainty slows decisions. The move-up market stalls. Then there's the move-up buyer. Families who bought smaller homes years ago. Families who expected to upgrade. Historically, this segment fuels inventory flow. Starter homes get listed. Mid-tier homes change hands. Luxury properties move upward. But remember the lock-in effect. A homeowner with a 2.8% mortgage is reluctant to replace it with 7% debt. Even if they have equity. Even if they need more space. Financially, staying put often makes more sense. So instead of selling, they renovate. They finish basements. They convert attics. They expand kitchens. Contractors stay busy. But listings do not. The move-up chain breaks. And when that chain breaks, homes sit longer. Urban cores versus suburbs. There's another split emerging. Urban condos in dense areas face a different challenge than suburban single-family homes. During the pandemic, demand shifted outward. Space became premium. Proximity to offices mattered less. Now office attendance is partially returning. But not fully. Hybrid work remains common. So what does that mean? It means demand patterns are uneven. Some suburban towns remain relatively stable. But certain downtown condo markets experience softer absorption. In parts of Manhattan and older Northeast city cores, buyers weigh HOA fees, building age, and long-term appreciation differently now. The urban premium isn't automatic anymore. It must justify itself. And buyers are calculating carefully. The investor pullback. During the pandemic boom, institutional investors expanded aggressively. Single-family rentals became a strategy. Build-to-rent models accelerated. Capital flowed into residential assets. But as interest rates rose, financing costs increased for investors too. Yield calculations shifted. Acquisitions slowed. In the Northeast, where price-to-rent ratios are already tight, investor margins compress faster than in lower-cost regions. When institutional demand cools, it removes a layer of competition. And fewer bidding wars means slower sales velocity. Homes that once sold above asking now require negotiation. Sometimes multiple rounds. Demographics don't move overnight. Another structural layer lies beneath the surface. The Northeast population is aging. Baby boomers own a significant share of housing stock. Historically, downsizing created inventory. But many older homeowners are staying longer. Healthcare advances increase longevity. Remote services make agging in place easier. And again, mortgage rates play a role. If a homeowner owns their property outright or holds ultra-low debt, selling may not be urgent. So inventory turnover slows. Not dramatically, but measurably. At the same time, younger generations face affordability hurdles that delay entry. Fewer first-time buyers. Fewer move-up sellers. Agging homeowners staying put. The flow constricts. The pricing illusion. Here's something subtle but important. Prices in many Northeast markets haven't dropped sharply. At least not on paper. Median prices may appear stable. But what's happening beneath the surface? Sellers list high. Homes linger. Then price cuts appear. 5%, 7%, 10%. The transaction eventually happens, but below initial expectations. The illusion of stability masks slower momentum, and buyers sense it. When buyers believe time is on their side, urgency fades. And urgency is what drives fast sales. The psychological reset. In 2021, buyers feared missing out. In 2025, buyers fear overpaying. That psychological shift alone changes behavior. Instead of racing to submit offers, buyers attend multiple open houses. They compare. They wait. They negotiate harder. Inspection requests become detailed again. Appraisal contingencies return. Sellers who remember the frenzy struggle to adapt. Some resist lowering prices. Some withdraw listings temporarily. Some rent their homes instead of selling. But the days of instant offers are largely gone. And the market feels different. Not broken, just slower. Strategic decisions matter. Here where power shifts. In a fast market, strategy matters less. Momentum carries listings. In a slower market, strategy becomes decisive. Pricing must align with current conditions, not past peaks. Presentation must stand out. Marketing must reach targeted buyers. Timing matters. Even microlocation within a town matters more now. The Northeast market is no longer forgiving. It rewards precision and penalizes complacency. But this story is still unfolding. Because the final piece isn't just about buyers or sellers. It's about capital, about regional economic shifts, about what happens next. In Part 3, we'll explore how job growth patterns are reshaping Northeast demand, the long-term impact of remote and hybrid work, why luxury properties face a unique challenge, and whether this slowdown is temporary or transformative. Because when homes sit unsold, the surface tells one story. But beneath it, a deeper economic recalibration is taking place. And that recalibration determines who wins the next cycle. The economic recalibration. Real estate does not move in isolation. It follows capital. It follows jobs. It follows confidence. And right now, the Northeast stands at a crossroads. Not collapsing. Not booming. Repositioning. Quietly. Strategically. Where the jobs go, housing follows. For generations, the Northeast dominated high-paying industries. Finance in Manhattan. Biotech in Cambridge. Education across Boston. Corporate headquarters scattered from New York City to Boston. But job growth has diversified geographically. Technology expanded into Austin. Finance roles spread into Florida. Remote hiring blurred state lines. This doesn't mean the Northeast is losing relevance. It means competition increased. When job growth disperses, housing demand disperses with it. And marginal demand, the extra buyer who tips a market into bidding wars, becomes less concentrated. Without concentrated demand, homes take longer to sell. Not because nobody wants them, but because fewer buyers are competing at once. Hybrid work changed the premium. Before 2020, proximity to office districts justified price premiums. Shorter commutes meant higher values. A condo near Midtown Manhattan carried built-in advantage. But hybrid work recalibrated that premium. If employees commute 2 days a week instead of 5, how much is location worth now? The math shifts. Some buyers still prioritize city access. Others calculate differently. They weigh square footage against commute time. They compare suburban tax burdens to urban condo fees. They measure lifestyle flexibility. That recalculation softens urgency. And urgency is what once cleared listings in days. The luxury layer. There's another segment feeling the shift. Luxury. In the Northeast, high-end homes often carry significant property taxes. Maintenance costs scale with size. Older estates require constant upkeep. When stock markets climb rapidly, luxury buyers move confidently. But volatility introduces caution. Wealthy buyers rarely disappear. They delay. They negotiate more aggressively. They demand concessions. Luxury listings that once relied on momentum now require strategic pricing and patience. And patience extends days on market, sometimes dramatically. In affluent suburbs outside Philadelphia or along Connecticut's coastline, high-end properties are taking longer to transact than mid-range homes. Not because buyers lack money, because they value leverage. The tax equation. Taxes play a quiet but powerful role. The Northeast carries some of the highest property tax rates in the country. State income taxes add another layer. During economic expansion, those costs feel manageable. But when borrowing costs rise and inflation pressures household budgets, every recurring expense matters more. Buyers calculate long-term carrying costs carefully now. Not just purchase price. Total ownership burden. That scrutiny slows decision-making. And slower decisions extend listing timelines. Construction constraints. Unlike many Sun Belt cities, large-scale new construction in the Northeast faces geographic and regulatory limitations. Zoning approvals can take years. Historical districts limit redevelopment. Infrastructure upgrades require coordination. That constraint historically protected home values. It still does. But it also limits adaptability. When demand shifts toward newer, energy-efficient housing, the region cannot pivot quickly. Older housing stock requires renovation. And renovation costs surged post-pandemic. So buyers weigh the cost of upgrading aging homes against purchasing in newer markets elsewhere. Sometimes they hesitate. And hesitation creates unsold inventory. The subtle supply increase. Here's something many overlook. Inventory doesn't need to explode to change market psychology. It only needs to rise modestly from extreme lows. During 2021, inventory reached record scarcity. Now, even a return to pre-pandemic averages feels abundant by comparison. When buyers see more options, they slow down. Scarcity creates urgency. Choice creates patience. And patience lengthens time on market. That shift alone explains much of today's unsold narrative. Media narratives and confidence. Markets also move on perception. Headlines about national slowdowns influence local behavior. When buyers read about price corrections in other regions, they anticipate similar trends, even if their specific town remains stable. Confidence softens, and softened confidence means fewer impulsive offers. The Northeast historically benefits from strong institutional presence: universities, hospitals, finance, government. These anchors provide stability. But stability does not equal speed. And today's market is defined by slower speed. This is not 2008. It's important to separate fear from reality. In 2008, credit markets froze. Foreclosures surged. Inventory flooded. Today's environment is different. Homeowners hold more equity. Underwriting standards remain stricter. Distress levels remain relatively contained. What we're seeing is recalibration. A market adjusting to higher capital costs. A market transitioning from stimulus-driven expansion to rate-driven discipline. And discipline slows transactions. Strategic patience becomes power. In fast markets, speed wins. In slower markets, patience wins. Buyers who analyze deeply gain leverage. Sellers who price strategically outperform neighbors. Agents who understand microtrends succeed. The Northeast housing market isn't failing. It's filtering. Filtering out speculative demand. Filtering out impulsive overbidding. Leaving behind more calculated participants. That filtering process takes time. And during that time, homes sit. But one final question remains. Is this slowdown temporary? Or is the Northeast entering a longer structural shift? In Part 4, we'll examine long-term demographic forecasts, whether migration patterns will reverse, how interest rate trajectories could reshape demand, and who ultimately gains the advantage in this new cycle. Because every slowdown creates opportunity. The only question is, for whom? The next cycle of power. Real estate cycles do not announce themselves loudly. They transition. Gradually, quietly, almost invisibly, until hindsight makes the shift obvious. The Northeast housing market is not collapsing. It is recalibrating. And recalibration always redistributes power. The question is simple. Who benefits next? The interest rate variable. Everything now orbits one central force. Interest rates. When the Federal Reserve raised rates aggressively under Jerome Powell, the objective was clear. Control inflation. Slow the economy. Cool excess demand. It worked. But higher rates do not just slow spending. They reshape housing strategy. If rates gradually decline over the next few years, pent-up demand could re-enter the market. Buyers who paused may return. Refinancing expectations could restore confidence. But if rates remain structurally higher than the 2010-2021 era, affordability will not fully reset. That would mean the Northeast must compete not on cheap credit, but on fundamentals. Fundamentals still matter. And here, where the Northeast remains powerful, it holds dense concentrations of education, world-class hospitals, finance infrastructure, cultural capital, legal and government institutions. Regions anchored by durable industries rarely deteriorate quickly. They adjust. Consider history. After the fiscal crisis of the 1970s, New York City was declared unstable. Many predicted long-term decline. Instead, it reinvented itself. Finance expanded. Technology emerged. Global capital returned. After 2008, skepticism resurfaced. Yet within years, values rebounded. The Northeast has endured downturns before. But survival does not mean stasis. It means evolution. The demographic equation. Population growth in the Northeast has slowed compared to southern states. That trend may persist. But demographic trends are rarely linear. Young professionals continue to migrate toward opportunity hubs. International immigration historically flows into gateway cities like Boston and New York City. If immigration levels expand in coming years, housing demand could strengthen. If remote work contracts and office presence increases, proximity may regain premium value. Demographics move slowly. But when they turn, housing markets follow. The sellers who adapt. The next cycle favors strategic sellers, not hopeful ones. Homes priced accurately from day one move faster. Properties renovated with efficiency in mind outperform aging inventory. Energy costs matter more now. Layout flexibility matters more. Buyers want offices, natural light, modern systems. The Northeast contains some of the country's oldest housing stock. Those who modernize effectively gain advantage. Those who anchor to past peak prices risk stagnation. In slower markets, precision beats optimism. The buyers who waited. For buyers, slower markets create leverage. Negotiation returns. Contingencies reappear. Patience produces opportunity. But timing cycles perfectly is rare. Historically, long-term ownership in economically durable regions has rewarded disciplined buyers. The key difference now is selectivity. Not every neighborhood performs equally. Not every property holds the same resilience. Micro-markets matter. Street-level differences matter. Data matters. Institutional capital watches closely. Large capital pools do not disappear. They reposition. If borrowing costs stabilize and rental demand remains firm, institutional buyers could re-enter selectively, especially in areas with constrained supply. The Northeast's regulatory complexity limits rapid overbuilding. That constraint can protect long-term pricing floors. Capital understands scarcity, and scarcity remains embedded in much of the region. Is this a structural shift? Here is the deeper question. Has remote work permanently diluted the Northeast premium? Or is this a temporary adjustment to extraordinary pandemic distortions? The answer may be both. Some migration patterns will persist. Some will reverse. Some households will value lower taxes. Others will prioritize network density and opportunity clusters. Housing markets rarely move in absolutes. They fragment, and fragmentation creates divergence. Some Northeast towns will stabilize quickly. Others may face prolonged softness. What unsold really means. When headlines say homes are sitting unsold, it suggests weakness. But unsold does not automatically mean decline. It often means negotiation. It means equilibrium forming. It means the removal of excess momentum. In 2021, speed defined the market. In this new phase, balance defines it. Balance can feel slow, but balance is not collapse. It is normalization. The long view. Zoom out 20 years. Northeast real estate has weathered recessions. Interest rate spikes. Policy shifts. Technological revolutions. Through each cycle, values fluctuated, but the region's structural anchors remained. Education, finance, healthcare, government, infrastructure. These foundations do not vanish overnight. They evolve. The final shift in power. Every cycle transfers leverage. From buyers to sellers. From sellers to buyers. From speculation to discipline. Right now, leverage tilts toward the patient. Toward the analytical. Toward those who price and purchase based on long-term fundamentals rather than short-term frenzy. Homes sitting unsold are not symbols of failure. They are signals. Signals that the market is recalculating, rebalancing, reassessing value in a higher-cost capital environment. And recalibration, while uncomfortable, creates clarity. The Northeast housing market is not ending. It is adjusting to a world without ultra-cheap money, to a workforce with greater mobility, to buyers who demand precision. The frenzy is gone. The fundamentals remain. And in real estate, fundamentals always outlast momentum.